as a financial advisor, one of the questions my clients have been asking me lately is, hey Azul, what do you think is going to happen with the cost of living crisis? Are things going to come back down? Are prices coming back down? Or are we in a new norm? Let's go for a little walk and I'll share with you what I'm sharing with them. And the first thing I share with them is, unfortunately, the last mile of inflation is the toughest to beat. So the move, inflation had gotten up to over 9%, and the move from 9% to 4% happened pretty quickly. And I think a lot of folks thought, if we can go from 9% to 4% in under a year, then surely we can go from 4% to 2% in another 6 months or 12 months. But unfortunately, that's not the way it works. The last mile is the most stubborn and is the most difficult. And right now there's an adage, people are saying, higher interest rates for longer. Higher for longer is the phrase. And unfortunately, I do think that that's true. A lot of folks were calling for interest rates to be cut in the first half of this year as I record this, but that didn't happen. And hopefully we do see interest rates cut and we get some relief so mortgage rates can come down. And not only mortgage rates coming down, but there's a lot of folks that are kind of locked into their house. I tell my clients, if you got a mortgage or you refinance during the pandemic and you have a 2.5% or 3% mortgage, that's great news. But I tell them, I hope you like your home because you could be in it for a while. And I don't think interest rates mortgage rates in particular, are going to come down to that level anytime soon. But I do think they'll come down back to historic norms or maybe a little bit below historic averages. But I should also share that interest rates are one of the hardest things for anybody to forecast. Even, somebody that's a banking expert and this is what they're looking at all day long is interest rates. So while I'm a financial advisor, my track record for predicting interest rate moves is no better than anybody else's, which unfortunately is pretty bad. Okay, so getting back to the main point outside of interest rates, what's going to happen to the cost of living crisis? And part of what allowed the prices to skyrocket like that is the economy was really flush with cash. The government issued a lot of stimulus checks. The consumer had more cash than in any time in recent history. And consumers were buying. And that propped up the economy, but it also shot up prices. For instance, the price of a new car before the pandemic, the average price of a new car was between $35,000 and $40,000. And now it's a little bit above $50,000, the average price of a new car. And that's a big, big move. So not only did the consumer have more cash and that led to higher prices, but the consumer also was able to prop up the economy. And now that we've spent that stimulus money, now what's going to prop up the economy? There's a saying in my industry that if you get the consumer right, you'll get the economy right. And what that means is 2/3 of the economy is based on consumer spending. The rest of it is like business spending and other goods and services outside of consumers. But for a long time, the U.S. economy has been 2/3 based on the consumer. We are a consumer-based economy. And if you get the consumer right, if the consumer is healthy, then likely the economy is going to be healthy. And one of the concerns is the consumer right now is healthy, and that's driven by low unemployment. So even though the excess cash is gone, most of us that want a job, not all of us, but most of us that want a job can get a job. It's getting a little harder. But that has propped up the economy. And unfortunately, time's not on our side. The longer it takes to get the economy to cool, to get inflation in particular to cool, the more likely this low unemployment rate will likely go away. There's no guarantees. I don't have a crystal ball. I really wish I did. But mine is cracked, unfortunately. So the longer it takes, the more likely it is that we're going to face some economic pain. And that could have likely have an impact on unemployment, and then all of a sudden the challenge to get inflation under control gets much more challenging, because right now the Fed's had a pretty open field because they have a dual mandate, not just to get inflation at about 2%, but also to maintain the economy at full employment. And currently it's easy to argue that we're at full employment. But if unemployment starts rising, now the Fed doesn't have as many tools, they don't have as much freedom as they have right now. Okay, the next one is housing cost. You know, we all know how expensive housing was before the pandemic, and that situation's only gotten worse. And that's also trickled down to the rental industry. So the rental market, I should say. You know, rents are at all-time highs, and many of us do not have an alternative. If you don't own a house, it's harder than ever to qualify to buy a house. And so the market of renters, the supply of renters, is at an all-time high. And so landlords do not have a lot of pressure to lower rents. And so when you look at the biggest components for us from a living standpoint, right, and the question here is what's going to happen to the cost of living? I do not see rents coming down anytime soon. And even when the housing, even when if and when interest rates fall and people start putting more homes on the market, I think it's going to be in trickles. I don't think there's going to be a floodgate that opens and people are going to be putting their house on the market. So we're in an unusual time where higher interest rates, higher mortgage rates really have not dropped the price of houses. Case-Shiller does a report that they issue every quarter. As I record this, the latest one just came out, and yet again, housing prices continue. In fact, in San Diego, the housing prices, I believe, were up 10% year over year. Now that's one market, but in general, the U.S. housing market, if you're a homeowner and that's an asset for you, the U.S. housing market was very healthy, which is good for existing homeowners, but not so good for people that want to buy a home. And we're in this situation, frankly, because there's not much inventory, because people are very reluctant, and understandably so, to to exchange their home where they have a 3% or maybe even a 2.5% mortgage and take out a loan that, you know, as I record this, you know, loans are, for most people, 3-4 percentage points higher than what their existing loan is at. So there's a lot of hesitancy there. And the thing I'll share at last that I think is really important is if you look at the government debt, if you look at U.S. government debt, it's right now, and this is just at the federal level, $34 trillion. And if you look at that on a per citizen basis, that's $100,000 per citizen of the United States. And let's say that the U.S. pays on average, I think this is high, but just for easy math for me, 5% interest on our debt. You know, that's $5,000 per citizen just to pay the interest on that debt. And the average, the median, I should say, U.S. salary is a little over $50,000 a year. So that is 10% of the average gross pay before taxes, before any other expenses that people have. So for the average American, that just paying their part of the interest, forget about paying down the principal, is 10 percentage points. So do I think the cost of living crisis is going to come down anytime soon? I wish my answer was yes, but unfortunately I think we're in this situation for at least a couple more years. And I hate to say this, but I do feel that we've entered a new norm where life is going to get more expensive, which is why I think it's more important than ever. It's harder than ever, but it's more important than ever to save as much money as you can. And that's why I made this video here where I talk about why getting to the first $100,000 is so hard, but it gets easier after that. So thanks for watching this video, and I'll see you in that one. Bye-bye.